And it's a double-edged sword. The good news is that might help the Fed in its fight against inflation. It might also push things too far into a hard landing or a recession. What's your outlook on that score? And was the Fed right to put through its most recent quarter point increase?
David, you're correct. It's a tougher situation. The Fed, in essence, is outsourcing part of their monetary policy. The Fed understands right now that banks are contracting credit availability and credit's getting more expensive, and they're factoring that into their equation on what economic growth will look like. So the Fed is no longer completely in control by pure interest rate policy and quantitative easing or quantitative tightening. They've done a little bit of both recently on controlling what inflation looks like. My opinion was in the last meeting, they had to raise by the 25 basis points. You know, prior to the bank failures or bank collapses and the bailout of the couple banks in early March, you know, the Fed had already sort of committed themselves to 50 basis points. The market had priced in 50 basis points. For the Fed to have gone from 50 basis point increase based on the economic data to zero, I think they would have lost credibility. So a good compromise position for the Federal Reserve was to end up at 25 basis points, but then in the press conference for Chairman Powell to talk about his understanding of what was going on in the economy, the contraction in credit, and the fact that they're quite aware there's a contraction in credit and that they'll be more observant of what's going on and they'll be more economic data dependent going forward. And I think, you know, they've got a month off till the next meeting and they'll see where we are in the economy before they make their next decision.